We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Gentile, strategic investor in the junior mining sector and co-founder at Bastion Asset Management. Michael, thanks for joining me today. How are you?
See you again, Tom. Great to see you.
It's excellent to have you back, and I'm really looking forward to digging into a lot of the mining sector with you today. You know, you and I have spoken about this before. It's been a little while since you've been on, and it really seems like we're at extremes again here in the industry. So with the gold mining sector and really the mining sector as a whole, which we can kind of talk about, really being so undervalued at the moment, is this a particular point where, let's say, reversion to the mean helps manage some of the, let's say, the entry risk to getting into this sector?
Yeah, I mean, Tom, I've been investing in commodities for 25 years now, and I've never seen a setup like this in my career. You know, usually I've learned over the years to invest in commodities when sentiment is very poor, when the commodity is at a low price and people are very pessimistic about its future, and when you have a positive view. That's usually how this setup, where you can make an extreme amount of money in commodity investing. So that's really what I did in 2018. Gold was around $1,300 an ounce. I started getting interested in gold in 2015, 2016 when gold was $1,100, but I made a huge personal bet with a lot of my net worth in the gold mining space in 2018 when gold was $1,300 an ounce. And the outlook I thought was very, very good for gold. You fast forward to today, gold's $3,200, $3,300 an ounce, depending on what your screen's showing right now. And the gold mining stocks have not responded. So you've had almost a tripling in the gold price, or doubling or tripling of the gold price. And most of the gold equities are trading well below where they were in even 2016 or 2020 for that matter. So it's highly unusual. So sentiment remains really poor while fundamentals are fantastic. And we can go through that a bit later in the interview. So the cash flows, the balance sheets of these companies, the earnings power of these companies are phenomenal. Yet stocks are really, really cheap. So you're right, Tom. Usually to make a lot of money in commodities, you got to take a bit of risk that you're right on the commodity and that things are going to turn around if you want to get really good bargains. Right now, the stocks are trading at depressed levels indicative of a very low commodity gold price, while the gold price is quite robust. So you do have a lot less risk in this trade, and catch up, mean reversion, you know, whatever you want to call it, I think is definitely in the cards. I've seldom seen a setup like this in terms of risk reward opportunity, which is why essentially I've been all in on gold the last couple of years, because my thesis keeps playing out better and better in terms of the macro. Mm-hmm. The stocks are lagging, but it's creating a really compelling entry point for investors here.
Yeah, it really seems that you mentioned the idea of the fundamentals never really being better. So what do you think is, let's say, the precipitating event, or what do we need on top of such a good fundamental setup for this mean reversion to begin?
Yeah, so I'll just show you. I'm going to share a couple slides with your viewers here. This kind of sets the stage. So GDXJ, this is basically the junior gold miners index. You know, market cap's around 300 million to about 5-6 billion market cap. You know, single asset producers, two asset producers. This kind of illustrates our point, right? In 2011, the high of the last gold market, when gold was $2,000 an ounce, the GDXJ was between $160 and $180 a share, right? You fast forward today, gold is $3,300 an ounce, and it's 61. Or less than that today, below 60 today. It starts out there for the last couple of weeks, but it gets you an idea. So this index is down more than 50% from its highs, while the gold price is up, you know, close to 80% higher than it was the last time gold was at its high. So that's a pretty striking chart, just to kind of set the stage for how compelling the valuation is. This is the HUI, which is a basket of U.S. listed gold mining stocks divided by the gold price. So, you know, the lower the index versus the gold price, the lower this chart's going to be. And you can see 2015, COVID lows in 2020, and today, the index has never been at this level before. So, you know, 2015, we all remember gold was $1,100 an ounce. People thought it was a relic. It was going below 1,000. You know, Barrick, Teck, many of these mining companies were basically going bankrupt. So the biggest companies in the business were quasi-insolvent back then. So you can understand why the mining industry stocks were trading at a low. COVID, we all know that panic low and the whole stock market crash. You're there. Today, like we said earlier, you've never had more robust fundamentals for the industry, but we're trading back at the two most panicky low valuation points we've seen probably in the last 30 years in the gold sector. So that just sets the stage of, again, how cheap these stocks are. A great question you asked, Tom, is, the fundamentals, what's happening here. So I love this chart. This is the Bank of Montreal. This is the industry-wide total costs to produce an ounce of gold. That includes everything: growth capital, cash costs, all the cash outflows in the industry. That's the gold line is kind of their gold price forecast. So their current gold price forecast is around $3,800 an ounce, just right about where we are today. And you can see how for most of the time, Tom, the margins in the industry are pretty skinny. In 2015, when the industry was almost going bankrupt, you could see their gold price forecast was basically equal to the total cost of the industry, which means the industry was generating industry-wide 0 to negative free cash flow as a whole industry. And a capital-consuming industry, that's a very bad place to be. You look at 2020, last time we had a big run in the market, the gold price spiked, costs were relatively fixed, and we had a big margin expansion. This is this green bar over here. And we had a huge run in gold juniors, went up anywhere from 100 to 1,000% in a very short period of time. Mm-hmm. What happened after that was that the gold price flattened out. It never really broke above $2,000 an ounce. But the costs for the industry went steadily higher because we were in a hyperinflationary period. So those margins collapsed. And therefore, there was a lot of disappointment in the industry that the high gold prices didn't translate into higher earnings and free cash flow. Now, you look today from 2024 to 2025, the margin expansion that we're seeing in this industry, this green bar is multiples of what we've ever seen in the industry, which means the industry is making record profits, record free cash flow. These companies have never been more profitable in their history. Their balance sheets are clean. This margin expansion is what attracts generalist investors, average portfolio managers to come and get interested in the sector again. And we're starting to see that in the Q4 and Q1 results. The free cash generation of these major mining companies has been phenomenal. And yet the stocks are still trading, like per my first slide, at much, much lower levels than they were in 2020 or even 2021 or 2011 when the margins were much, much lower. So I think this is a big thing I've been keeping my eye on. I think it's going to be a big catalyst to see sector rotation or fund flows come into the mining sector, because the average investor in my space, generalist investor, wants to see improving fundamentals. And there's no sector in the market today, especially all the tariff fears and the slowing economy that we're seeing, that has improving fundamentals better than the gold sector.
Mm-hmm. Well, Michael, going back to that BMO chart, it's amazing to see, let's say, the margin expansion this year looks to be, let's say, something like 4 times more than in 2020 and however many times bigger than in 2016. And of course, we saw from the second chart you had mentioned or that you had shown that those were really the last 2 times that we had a small bull market, both very attenuated, but small bull markets in the gold mining sector or especially the junior mining sector. So what do you think the commonalities or the drivers were in those two times in 2016 and 2020?
Yeah, it's a great question. I mean, you always say history doesn't always repeat, but it rhymes, right? It rhymes doesn't repeat, So I think in 2015, I remember those days well. I went to the major mining conference in 2015 and gold was $1,100 an ounce. Like I said, Barrick was on the ropes, Teck was on the ropes. There was just maximum pessimism. People had just thrown in the towel, said all these companies are worthless, they're not worth anything. And everybody thought gold was going to go from 1,100 down to below 1,000, right? There was articles saying gold was a relic and was no longer necessary in the financial system. So in that moment, Tom, sometimes you have explosive rallies based on positioning. So everybody's short, nobody owns these stocks. The massive consensus, 100% investors think a sector is completely uninvestable. And lo and behold, what happened in 2015? Well, the gold price didn't go from 1,100 back to 900. It went from 1,100 to 1,300. And everybody was caught off foot. And we had this explosive rally. As the gold price rallied, a lot of companies were over-levered and they were able to delever their balance sheets and come out of financial distress. And the stocks had a big move. But then what happened was the rally didn't continue. So from 2016 till basically about COVID, gold was just kind of bouncing around and didn't sustain that momentum. So the rally kind of petered out. So that was more of a rally where you have max negative positioning, kind of like we just saw in the tariffs. Everybody got super, super negative on tariffs and the global economy is going to collapse. All of a sudden, the S&P is up 20% in 3-4 weeks when the tariffs weren't as bad as people thought, and people were all caught off foot. So there was maximum pessimism. You get a change of a playbook, and the stock market rallies. But those are hard to sustain because it's really just sort of almost short covering or a quick snapback rally from pessimism to optimism. 2020 is more apropos of what we're seeing now, which is the gold price went up, margins expanded massively, the stock market reacted accordingly, and the prices of gold stocks really lifted higher because the market was anticipating a period of elevated margins. What the market missed in 2020 was that we're entering a period of hyperinflation. So the gold price moved first, but the costs caught up quickly, and those margins were getting compressed ever tighter as every year went by, and people got disillusioned again. You fast forward to today, you're right, Tom, that margin bar is like 4 or 5 times bigger than it was in 2020. So first of all, we have a lot more margin room to sustain any increase in costs or decrease in the gold price. So we're wildly profitable. And secondly, the gold price increase this time around has not been driven by inflationary fears. It's basically been driven by a major repositioning of US dollar versus gold and US dollar's status as a reserve currency in the global economic system. So we've been seeing massive central bank buying, massive physical buying of gold, which I believe is a long-term megatrend, and therefore supportive of a higher gold price, which should allow margins to stay fatter for longer. And these stocks are still in a period of disbelief, I believe, where they believe these margins are not sustainable. It's going to happen again. But every quarter that goes by where they're piling cash on the balance sheet, buying back their stocks, paying special dividends, it's going to be very hard to ignore. And I do believe the margins will be sustainable for much longer in this cycle, and therefore attract a larger pool of generous investors that after 2, 3, 4, 5, 6 quarters of incredible results will no longer be able to ignore how positive and how profitable the sector is going forward.
Michael, when we think about exactly as you're saying, this margin expansion, how far into having excellent return, basically throwing off free cash flow for the producing miners, how far into that are we? And with the context of what you just said, of being able to show, I think you said 4, 5, 6 quarters of excellent free cash flow, attracting capital back into that space.
Yeah. So, as you know, too, Tom, the gold price is a lags through the filtering through the financial statements. So I just got through a lot of the producers' Q1 reports. So I was doing a bunch of earnings calls this week and a bunch of producer earnings transcripts that I read through. The average gold price realized for this is anecdotal, I don't have a scientifically calculated number, but it's between $2,750 and $2,900 an ounce in Q1. Mm-hmm. And these companies, the quarter before might have been between $2,400 and $2,600. So people are panicking, the gold price is down from $3,400 down to $32, $33 because tariffs have kind of taken a little bit backseat the last couple of weeks. The current gold price of $3,200, $3,300 an ounce is still $300 to $400 higher in Q2 where we are now versus what the companies realized in Q1, and significantly higher than they were in Q4. So to answer your question, we're going to see even higher margins in Q2 than we saw in Q1 because the gold price is going to be, realized price will be well above what it was in Q2. And then by the time you get to Q4, same thing, year over year, it's going to look really, really good. So we got another 3-4 quarters of record margins ahead of ourselves. Another thing I would say is even the gold price pullbacks, like in my models at the office, Bastion Asset Management where I work, I'm running $3,000 gold. I was running $3,000 gold as my stretch gold price in my valuations. So, we're still $200, $300 above my stretch target. And at $3,000 gold, many of the companies that I follow, the mid-cap producers, have anywhere from 25% to 60% free cash flow yields in 2026 next year. And so just reviews what that means. That means 25 to 60% of their market capitalization generated in free cash flow in a single year. So those are just wild numbers. So just gives you a bit of context of how juicy these margins are, how much free cash the industry is generating. So even a modest or a large pullback in the gold price from here, you're still going to see never before seen profitability, never before seen record free cash flow margins, which will be very attractive to investors and should start to increase the valuation multiples investors are willing to pay on these stocks.
I think that's an interesting point of basically building a model of profitability based on a conservative gold price. But let's say if some of these miners are using a $2,500 gold price, that makes their projections look not as attractive as they possibly could be. Do you think that's something that the market kind of ends up missing because they're looking at the projections based on a conservative gold price? Like it does seem kind of backwards, but do you think that plays a role here as well?
Yeah, the companies are calculating many companies are calculating their reserves and resources at $1,500 to $1,700 gold. Yet gold's above $3,000. They also calculate their capital costs for new investment projects based on current pricing. So gold is always a function of inflation. Like the more inflation goes higher, the more the dollar gets devalued, the more it's going to cost you to build a mine, but the higher price you're typically going to get for the metal that you sell in the future. So you're right, Tom. You're penalizing your reserves and resources. You're also putting a below market gold price in your economic assessments but putting market capital costs. So you're in a rising gold price environment, you're making projects look less profitable than they otherwise would be. At the same time, we all know, viewers of your show, that the gold price is very, very volatile. So I don't recommend saying, okay, the gold price is $3,200 today, so let's put in $3,200 in our model and base our math off that. I like having a bit of a margin of safety or a buffer. So if I know that I can make a lot of money buying gold producers, if gold is $2,500 or $2,800, I'll make a ton of money. If gold is $3,000, I'll make money hand over fist at $3,200. That feels really good for me as a setup in terms of a risk reward trade. But yeah, you're right. You are penalizing that. And so you should put that into your factor into your analysis. So what is the actual gold price I expect to sell into when I build my project? What are the costs real time today? And what are my reserves and resources in a higher gold price in terms of mine life and potential expansion to that resource? Because a lot of resources will be economic that were not otherwise economic at $15 gold before. So there's a lot of factors, and you're constantly kind of triangulating in 3 dimensions when you're investing in the mining space. You're juggling a lot of factors. But again, to me, a lot of those factors are weighing heavily in favor of being long in the sector right now.
Mm-hmm. Going back to the macro side, if we could, Michael, it seems that there are a lot of people calling for, let's say, a global slowdown. How do you see this affecting the gold industry going forward as well? We do see, as you pointed out, these record margins. So even if the gold price pulls back, we're still in an excellent spot to show profitability within the industry.
Yeah, I would say, firstly, we talked about the fundamentals improving in the sector. We covered that really well. So that's good for generalist investors. Another thing is the way generalist investors think, and I've been one for 25 years with my partners, is you want to think where the puck is going. Mm-hmm. So we always think at the beginning every year, what sectors are going to see improving fundamentals? Those are ones you want to be long. And what sectors are going to see decelerating fundamentals or worsening fundamentals? Those sectors you want to either be not long or not owning or short if you're a hedge fund. So what I see with the tariffs that have been put in place and the economic slowdown you mentioned too is that there's been a massive amount of economic uncertainty. And I'm understating that because it's a massive amount of economic uncertainty inserted into the global economy. So most sectors are either heavily affected or partially affected by tariffs, either by the actual tariffs themselves or by the uncertainty that they create, and therefore the freezing of business investment or hiring. So if you're a small, medium, or large-sized business owner and you were contemplating a capital expansion, a new factory, a new plant, or opening a new restaurant or a new retail location, or you're planning to hire more workers to meet increased demand for your business, as soon as the tariffs came in, if I was a business owner, the natural reaction is everything's on hold. I'm not going to make that investment in a new factory. I'm not going to hire those new people. I'm not going to look at expansion. I'm not going to look at M&A. So you just see a deep freeze in terms of people's capital allocation. So that causes a slowdown, whether you're exposed to the tariffs directly or not. What I love about the gold sector is there is zero impact on the tariffs. There's been no tariffs placed on gold. Gold is basically money. You're digging money out of the ground. And so therefore, there is no impact of the tariffs. It's one of the few sectors in the market that are going to see zero impact from tariffs. And in fact, possibly a positive impact, which you've seen in the gold price, which is a slowing economy typically increases the price of gold. And we'll talk a bit later in the interview too about that repositioning of gold versus US dollar and central banks wanting to rotate their exposure away from the US. So in fact, the tariffs have been positive for gold and have no negative impact, where most sectors have a negative impact. So where the puck is going, that gives generalists a lot more confidence saying this is a sector I can deploy money to. Their stocks are cheap, the fundamentals are better, and there's no tariff overhang on this sector. Therefore, this feels like a really good place to put capital to work for the next 1, 2, 3, 4 years. And that's how portfolio managers think. And that has not been the case the last several years, Tom. There's been a lot of places to make money in the market. Tech stocks, AI, S&P's just been phenomenal. So investors haven't really had to worry about what else to put money to work. When something's working, you stick with it. And now you introduce a lot more uncertainty, a lot more choppy stock market performance. People are losing money for the first time in stocks in a while. That causes them to reflect, maybe change their bets a little bit, so reposition their portfolios into something new.
So do we have any indications that capital rotation is actually starting, Michael?
Yeah, absolutely. I'm just going to show you another few slides here. So we'll get back to that slide in a second, but this is interesting as well. So if you talk about, there's two kinds of rotation. There's the stock market rotation, and then there'll be, rotation and macros in terms of commodities and currencies. So this chart here, Tom, shows you that this is by Tavi Costa at Crescat. I think he's been on your show before as well. Brilliant guy, does some really good work. So I'll give credit to Tavi on this slide here. But this slide shows you the percentage of central banks holding in gold versus foreign currencies. So if you go back into the 70s, last time gold had a multi-year mega run, there was 65 to 75% of their foreign currency or the reserve central bank was held in physical gold. You fast forward to today, that number is down to about 15%. So you can see how central banks have been systematically selling gold for decades. And only starting kind of 2018, 2019 timeframe did they start to systematically increase their exposure to physical gold. Another thing that happened is the US dollar just became excessively dominant. So the foreign holdings of treasuries as percent of government debt, so the foreign owners of US debt, topped out at close to 95% in the 2010 to 2015 period. And you've seen a systematic selling off of foreign governments of US treasuries and rotating into gold. And there's a few things that happened here. What happened was, obviously, people got a little more concerned about the US financial situation, the rampant deficits, rampant debt, just out of control spending. People are getting more and more concerned that the US will not be able to repay them in dollars that are worth anything. Second thing that happened was in 2022, the Russia-Ukraine war. Terrible, terrible atrocities happened in the world. But from a macro perspective, what the US did is they froze the Russians' foreign currency reserves. So the Russians held a huge amount of money in US dollars. And overnight, because the US decided they were a bad actor, they basically lost access to all the US foreign currency reserves. Now, I'm going to stay out of geopolitics here, but over time, most every country in the world has had an issue with the United States. And currently, right now, most countries in the world do have an issue with the United States when it comes to tariffs. So if you're a foreign country that's had conflict with the US in the past, and you found out that a foreign country had all their foreign currency reserves frozen, what's your natural reaction going to be? Maybe I should own a lot less US dollars, because if I do get in trouble with the US, they could freeze them and take them away from me. So I should be selling my US dollars, selling my treasuries, and buying something that they cannot freeze, and that is physical gold. So you've seen a massive increase of central bank buying since the war in Russia and Ukraine as countries have diversified away from the US. And then the final kicker just happened recently with the tariffs, which is now all of a sudden all these countries have some major, not only geopolitical issues with the US, but kind of fiscal economic issues with the US. And they're going, well, if I'm in a trade war with the US and I've got a country that's imposing tariffs on me that they view are unfair, maybe I should be selling my treasuries and rotating money into gold, because I don't know the long-term future of that relationship and also the long-term financial stability of my country. So those three factors in a row have really kicked off what I feel is a multi-year tailwind for gold. Typically in the past, Tom, gold's been a financial asset. Hedge funds, financial investors have bought gold and speculated like in 2015 or 2020. This is a systematic, I think, reordering of the financial system that has major long-term implications for the gold price and stability of the gold price going forward, and should filter through to stock valuations. Let's just give you another slide here. I love this one. This is gold reserves as a percent of government debt. So we talk about, well, gold prices moved a lot. How can it go higher from here? If you look at in the 1940s, right before World War II, you can see that 40% of the US gold reserves were held as a percent of their total debt. So if they had, $1 billion of debt, they had $400 million of gold in the vault. If you fast forward to today with $36 trillion of debt, the US gold reserves are only 2% of their debt. And why does that matter? If you want to buy a currency, you want to know it's backed by something. The US dollar historically has been backed by the faith and confidence in the US government. Well, that faith and confidence in the ability of them to repay their debt is dramatically down. And the desire of foreign countries, like I said, to hold their currency is way down. So if you want to attract buyers of your currency over time, gold can give you that backing of your currency no one else can give. And so you're down to 2% where it was 40%. If you apply just a 17%, value of gold to the US debt, that would be a $24,000 per ounce gold price. Now, it sounds crazy. I'm not saying gold's going to 24,000. I'm just saying we've printed so much money and printed so much debt and devalued so much the paper money in our system that the gold price today is trading at a fraction of where it was if it reasserts itself as money in the economic system, which I think it's doing. And then the final picture of rotation, I would say, Tom, would be why is the gold stocks not worked or what's been happening? Well, this is a chart of the NASDAQ since the inception of GDXJ. So the day that the gold index was created, GDXJ, I think it was in 2009 or 2010, the NASDAQ has outperformed the GDXJ by about 20 times. So if you put money in the NASDAQ in 2009, you're up 20 times versus your investment in the gold sector. That's a self-fulfilling cycle where if you're like, I'm making so much money investing in tech stocks, why do I have to look at gold stocks? I'm making money hand over fist. Investing is easy. I'm super smart. Let me keep owning tech stocks forever. This chart here shows you, this is not updated until the last few weeks, but it's still pretty indicative. The last 12 months, how GDXJ has massively outperformed the NASDAQ for the first time in a long time. So GDXJ is up about 50% over year to date. And when I put in this chart, NASDAQ was sort of flattened down. And so that, for the first time, Tom, we're seeing investors sell their tech stocks and going, what could work that made GDXJ? And this is year one. We go back here, you see these outperformances can last for a long time once they get going. So I think we're seeing the early indications. See a little outperformance at the very bottom of the chart there, a little flagpole in the gold chart. These outperformances can last for many, many years once they start. So this is the early sniffs of both a macro rotation into gold and then also a secular rotation, stock market-based rotation into gold stocks.
Michael, you mentioned timing as well a couple times. You said at one point that you guys sit down at the beginning of the year and kind of look over the year, what's going to be profitable for the year. You mentioned this timeline as well of 1 to 3 years. Is that typically the ideal time that you're investing over, or how do you try to understand or position yourself from a timeline standpoint?
Sure. So I wear two hats, Tom. So some of your people who know me on your show get confused sometimes because they see me doing a bunch of different things. So I'll just kind of clarify. I invest my personal capital, a lot of my personal capital in the junior resource sector. Mm-hmm. So micro-cap stocks, discovery, pre-discovery resource names that I believe have potential to become mines one day. So that's part of what I do. And then another big part of what I do is Bastion Asset Management, which is an institutional money management firm, which I co-founded with two of my partners 3 years ago in Montreal. So we'll start with the institutional business, which is a little easy to understand. So that one there is your classic, pensions, high net worth, individual investors that come give us money, ask us to invest in the market. We invest in small mid-cap U.S. equities across all sectors. And so our view is we want to know what's going to work for the next 1 to 3 years. Really, we're looking for 30 to 100% upside when we get long a stock and 20 to 30% downside when we get short a stock. And so, we're really thinking at the beginning of the year, what sectors are going to outperform, what sectors are going to have the best tailwind to outperform, and then within those sectors, pick hopefully the best performing stocks with those tailwinds. And the idea in 1 to 3 years is that you want the fundamentals improving over multiple years. If a stock's going to go from, let's say, $10 to $30, you've got to have improving fundamentals, and the picture's got to be good enough when the stock is 20 for someone else to buy it from you up 100%, thinking it's going to go to 30. So you really want to have a multi-year positive outlook that allows you not only to get long a stock and make money, but then have someone else want to buy it from you, because we own big positions in our fund. So on millions and millions of shares, you want to have a good enough backdrop that someone else wants to buy it off you, even after you made a good profit in the name. In the junior mining space, what I'm doing there is much more of a venture capital approach. Mm-hmm. So I'm buying very early stage companies, $5 to $20 million market caps. Early when they made a discovery, they may have an emerging resource, they have a significant resource, but they're still several years away from being a mine. And so what I'm trying to do there is I'm buying 25 to 30 companies, 1% of my portfolio of my net worth in each individual investment I make. And I'm trying to make 20 to 30 times my money, not 30 to 100%, but 20 to 30 times my money. But when you're trying to make that kind of return, your failure rate is going to be very, very high. So my model is if I can find 3, 4, or 5 out of my 25 names that go all the way and become mines, and I buy them very early on in their life cycle, I can make 20, 30, 40, 50 times my money on those stocks. And the ones that naturally fail, because getting to a mine is very difficult, and most mines don't end up becoming, most investments don't end up becoming mines. All the other ones can go to zero or underperform, and I can still do fantastically well in my portfolio. So it's a VC kind of speculative portfolio. Like the guys invest in Google and Microsoft. Those guys that had VC portfolios that had Google and Microsoft in their portfolios way back when, they don't tell you that there are 30 names that all went bust. You just hear about Google and Facebook that end up being multi-baggers and huge return generators. But that kind of return profile can pay for a lot of mistakes and give you a fantastic return profile. But it's a little more complicated, kind of more experts only type approach. But I've been doing commodities for 25 years. Like I said, the setup looks really fantastic for those type of investments as well right now in the market.
Michael, you bring up the idea that those investors that bought maybe Google or Amazon, let's say, and that brings to mind to me this idea that it's very difficult to be able to hold that through its entire run. So when you're investing in some of these junior resource companies, are you looking to hold right to the point that they become a producing gold mine or mine in general? Or are you trying to understand the Lassonde curve as well and position yourself and get out at particular times at the end of the exploration cycle, or and buying back in maybe at the bottom before they start producing?
It's a great question. So for your viewers that don't know, this is Lassonde curve. It was named after Pierre Lassonde, one of the founders of Franco Nevada, one of the most successful investors in the gold space ever. So my time horizon, Tom, for a few reasons. One, when I get involved in a junior mining company a big way, I typically own 5 to 20% of the company. So I am taking that kind of private equity approach. I don't trade my portfolio. I'm owning big positions. I'm typically an insider. I'm on the board. I have a lot of influence over decisions that the company may make. And so naturally, these stories take a long time to evolve. So Lassonde curve, if you're, let's say, a company drilling a target for the first time, you make a discovery, that's typically when you have your first big return for investors. And then as you delineate that discovery and it hopefully gets larger and larger and larger, you can have a multi-year period where the resource is growing, excitement is building, and that's your first chance to make anywhere from 5 to 20 times your money on an initial discovery or more, depending on how important the discovery is. Then you get to the less exciting phase of studies, economic studies, costing your project, raising the money to build the mine. That tends to be a period where the stock might lose a bit of luster, but it's also a period where I like to get involved over here at the bottom of the kind of engineering phase when I really believe a project is going to cross the other side and become a mine. So there's two main periods, from discovery to defining a significant resource. And then as that resource gets more and more serious and moves through the study period and gets closer and closer to production, that's when a lot of takeouts happen. So these are two periods where you can make a lot of money. So my time horizon can be anywhere from 3 to 10 years because I want to capture this whole process and potentially part of this process as well before I exit. And my liquidity event will typically be a takeout because my positions are so large. So I'm really focusing in on companies that have the potential to go all the way. And that would be attractive to major mining companies who want to acquire the project and then spend the capital to put it into production. So it naturally, if you want to make 20 to 30, 40 times your money, you've got to be patient. And many investors make the mistake is they go up 40%, they sell that name, and they take a little profits, and then they hold the names that end up being zeros. They end up with a bunch of 40% returns and a bunch of down 80% returns on their dissolution with the sector. I was very fortunate, Tom, early in my career, one of the first stocks I bought was the oil and gas stock that went up 30 times. And so I was able to held it through the whole process. I saw the power that can do for the returns in your portfolio. So it's like, when you fall in love with something, your first love, you're like, you always come back to it. So I'm like, I've always been obsessed with finding stocks that can go up 20 to 30 times my money. Understanding there's a lot of risks in it. So I am much more patient than the average investor. And my goal is clear. I'm looking for those multi-bagger type returns. And therefore, I'm willing to hold some of the volatility. I'm willing to buy when it's a bit lower, add to my position, because I have my eye on the prize, I have the eye on the eventual value creation moment for those companies.
Right. Michael, do you look at any other assets or commodities, let's say, other than gold? Are you looking at silver projects, copper projects? Is there some combination of maybe a polymetallic asset that really is attractive to you?
Yeah. So coming back to my initial point, I would say when I invest in a sector, I have to have a positive view on the commodity. So I have to be typically invested in a commodity where the view on the commodity is negative and my view is positive. Or like we have in gold right now, which is extremely rare. The gold price is quite good, but the sentiment is still very, very poor. So I need to have sentiment to be poor, either one on two or both those things being negative, where my outlook is positive. So gold definitely fits that bill there. I would say I like copper. I would say copper price is pretty good right now. I would say sentiment is much better in copper than it is in gold. So I'm a little less allocated to copper than I am with gold because I feel like sentiment is still very poor and the best value that I'm seeing in the market is in gold stocks. I do really like polymetallic projects, like you said. My favorite combination would be a copper gold project or a copper silver project where you have a combination of the base metal I really like, which is copper, with some precious metals. And what that typically does is it gives you a bit of counter-cyclical value. So when the economy weakens, typically copper goes down, but gold and silver will go up. So you have a bit of a natural hedge in there. And typically it has projects that are more robust on the cost curve. I like uranium's long-term prospects, but up until recently it was very frothy around uranium. That air has come out of the bubble a little bit. So I'm open for business there looking at uranium names. They tend to be a little expensive. There's less names to invest in. Many of them are garbage, part of my language, but many of them are not going to actually become mines. It's very hard to build a uranium mine. So you got to be very selective in what you buy unless you're just trading it for short-term gains, which is fine. And then silver, I do like silver as well. But I would say in general, silver names are very expensive versus gold. So I'm a true value guy. So I've always had a hard time playing, 2 times NAV for a silver name versus 0.6 times NAV for a gold name, or paying 12 times cash flow for a silver producer versus 4 times cash flow for a gold name. But that being said, if I can find a silver project that has a fair valuation and a lot of upside potential in the resource or discovery potential, those are names I like to find. Or I can find projects that have, hidden silver elements to them. Some of the companies I've invested in have made significant silver discoveries that wasn't even the primary metal before it. So that if you can find silver as a kicker or as an adder to a project, you should get silver exposure at a much cheaper price. I like that as well.
You kind of bring up this idea of project timelines here, Michael, and this also brings in the idea of jurisdictional risk. In North America, our permitting timelines are extremely long. Do you think that we are maybe on the horizon of that actually possibly changing because of the need and the push, especially from Trump, to bring domestic supply back online? Do you think that the political really issues that stand in the way at this point can start to be relaxed so that we can get these permitting timelines back to a decent time to be able to make these projects feasible again?
Yeah, I was trying to share my screen. I had an example, but I'll just do it verbally with you. So I'd say two answers to the question. I would say they have to change. Part of the reason why junior resource stocks in Canada, North America, and the markets are trading at such depressed levels is the timeline to first production. So I read a stat the other day that from first discovery, that Lassonde curve slide I showed, from first discovery to first cash flow, the average project in Canada is 29 years from first discovery to first cash flow. Oftentimes it's because capital markets are not there, projects start and stop, there's a bunch of issues, right? So if you went really hard from discovery, you can do it faster, but in general, it's 29 years. Why that's important, Tom, is that because if you do a discounted cash flow model, and I tell you, Tom, I'll give you $1 million a year for the rest of your life, but it only starts in 29 years, right? You're going to pay me very little for that $1 million a year in 29 years because you got to wait so long. And by the time 29 years come along, you could invest the money for years and years earning a return, and the value of that money is going to be a lot less in the future as well. So that's why these junior mining stocks trade at low multiples, because the time for them to get into production and cash flow is so long. And I can only mainly speak to Canada. I think the US is similar. But I say in Canada, the reason why we've created this massive government bureaucracy on top of permitting mines. You've got to do the work on environmental consulting. You've got to consult your First Nation partners and the social licensing of that. But they've added provincial regulation to federal regulation to all kinds of different groups of permitting that it takes so long to permit a mine now that it's capital is fleeing Canada. I've heard some people talk about, they used to be investing in Canada and now they're going to Latin America. They're investing in Australia. They're investing in West Africa because the timelines are so long in Canada. So we've got to solve that problem. The US has taken some really good steps. I think the Trump administration recognized the problem and they put real people behind it. It's like Trump's new mining czar is one of the top former Newmont executives. So they actually put a real seasoned mine builder executive at the helm of a mining, which makes a lot of sense as a country. If you want to develop your natural resources, why don't you put someone there that has decades of experience building mines, not some career politician who's never been to a mine before.
Imagine that when these politicians actually have experience dealing with the sectors that they're in charge of, right?
Correct. So to give you the total opposite example, in Canada, under our previous Liberal Prime Minister, Justin Trudeau, the head of natural resources was a former Greenpeace environmental activist who had climbed a skyscraper in New York to protest oil and gas production. So you have one of the richest oil and gas countries in the world, one of the richest mineral resource, gold, copper, silver countries in the world. And your Minister of Natural Resources is an anti-mining, anti-oil and gas activist. Well, what do you think that's going to do to timelines in your country? Now, thankfully, that looks like it's changed. Our new Prime Minister just put a new Minister of Natural Resources in there. It's a executive from Goldman Sachs and Hydro One. So hopefully that'll change. But you got to start by putting the right people in the right places. And you got to start by streamlining the process to allow development to happen as quickly as possible in a sustainable way. West Africa, if you make a discovery, Tom, tomorrow, you can be in production in 3 to 5 years. Maybe that's too short. They probably got to stiffen up their environmental regulations, but that gives you an idea of the timeline, how quickly you go to production. I mean, Australia, maybe it's 10 or 15 years. Same thing in Latin America, maybe a little quicker. Canada and the US cannot be stuck at 30 years. That's going to just mean capital is going to flee those countries. You're not going to develop your resources. Your geopolitical security is going to be down. So I think I was very encouraged by the last election in Canada. A lot of the leaders were finally talking about the resources in our country, not as an albatross, but as a potential source of wealth and prosperity. But talk is cheap. Actions speak louder than words. So I'm going to be following very closely, both in the US and Canada, what we're doing to compress those timelines. I think it's a huge issue, Tom, for us as a society. We need these resources to develop our economies, green transition, geopolitical security. So we really need to see a sustained push. If that happens, that's more good news for the resource sector, because those timelines getting shorter just means the value of these shares are going to be going higher, and more interest will come to the junior resource market through that.
Mm-hmm. Yeah, it is very important. And I like the way that you kind of couch that, is the idea that we need to see action on it, right? And not just this promise or at least highlighting of the resources. Michael, as you look at possible targets to invest in, as you said, to try to make 20, 30, 40 times your money, are you looking at M&A targets, and do you have a particular size of resource in mind that you like to kind of target?
Yeah, that's a really good question. So because, Tom, I've done and did decades of institutional commodity investing before I started investing in the junior resource market, and I still invest heavily in the institutional market through Bastion Asset Management. When I got in the junior space, not being a geologist, not being a mining engineer, I've obviously brought into my networks people I really, really trust to kind of de-risk those projects. So I do that technical due diligence on the project as well. But what I really started to do when I started investing second time, I said, what are the characteristics of projects that are mines? So you start with success in mind, right? So what does a producing mine look like? What are the attributes of a producing mine? And then I work backwards all the way back to a $5 million market cap and try to superimpose those winning conditions on a very small company that hasn't ticked all the boxes yet, but has the potential. It's like kind of like in sports when you see a 10 or 12-year-old kid that has all the tools, all the athletic tools to be an Olympian or to be a pro baseball player. You go, this kid has what it takes to go all the way. A lot of things can go wrong, the work ethic, the path they take in life, the decisions they make, but this mine has what it takes to go all the way. So yes, I do look very closely at a bunch of factors, size being one of them, grade being another one of them, jurisdiction is one of them, infrastructure is one of them, right? A lot of things that come into the mix that tells me that if everything goes well and they perform according to plan, the resource delivers as I expect with the plan, this could be a mine one day. So that is absolutely what I'm trying to do. Again, because my time horizon is 3 to 10 years. I'm only making money in my mining investments if Agnico or Barrick or Newmont or Centerra or Alamos comes in one day and says, I like this project, I have the cash flow and the balance sheet to build it, I want to build it. Mm-hmm. And so you've got to be thinking about those red flags up front. And what that does for me, Tom, is it helps me say no. Like I say no to 99 out of 100 deals that get pitched me every single week, in terms of that. Because it's got one red flag or 2 red flags or 3 red flags that could keep it from being mine. I'm not interested in trading a stock. I'm not interested in having it make a good run on the back of good results. I want to know that it has all the potential to be a mine one day. And those are the ones I focus my attention on. And even then, I'm still going to be wrong probably 50% of the time or more because things will happen that'll derail the project. But you're putting the odds on your side. And by investing in projects at the right valuation, the right time in the cycle, with the right attributes, you're setting yourself up hopefully for success over time.
Right. And we didn't really touch on, let's say, targeted size of a resource.
Yeah.
Is that something that you really pay attention to?
So people get caught up in resources, but I focus on a few things. I don't really care about ounces in the ground. I care about are those ounces potentially economic. And so every project has a different thing. If you tell me you have 2 million ounces in Nunavut in the middle of northern Canada, and there's no roads, there's no power, there's nothing, no airstrip, no hydro, I would say that's too small. I say you probably need 10 to 15 million ounces in a greenfield area where you got to put all the infrastructure in. And even there, you got to be really careful because it still may cost more than you think to put the infrastructure in place. If you tell me you've got 1 million ounces in the middle of a major mining camp and there's 6 mills next to you and road and power and workforce and you can go home and sleep in your own bed and drilling contractors there, those ounces are highly likely to be cash flowing ounces. So I don't want to be aloof on your question, but every project is different. The hurdle of how much gold you need or how much copper pounds or tons you need and how much grade you need really depends on what's it going to cost capital-wise to bring this mine to production. If it's going to cost me $100 million of capital to put a mine to production versus $2 billion or $3 billion in the Andes in Argentina or Chile, I need to find a hell of a lot more gold and copper and silver to justify a $3 billion capex than a $100 million capex. Mm-hmm. So that's how I think. It's really what are the margins per ounce or per pound of copper you're going to produce? How much can I produce in a given year? And what's the total capital required comprehensively to bring this area into production? And those two numbers will solve for the right project size. But in general, the higher the grade, the better, right? Especially if you're underground. And if you're looking at a bulk project, the more bulk tonnage you have, the more ounces, the more tons of copper, the more pounds of copper you have, the better. And there's some rules of thumb, but I would say, for a new bulk tonnage project in North America, you're talking 10 million ounces at least or more. If you want open pit, it's got to be really, really big because these are like Côté, which is Iron Gold's project in Ontario. It's 20 million ounces, 400,000, 500,000 ounces a year. That's what the big companies want. They're not unlikely to go after an open pit with 100,000 ounces a year just because the social license is difficult. For underground, it's a little easier. So the higher the grade, the better. You can have more bespoke mining. You can have a smaller project. But I love high grade in a camp where you're the highest grade and there's existing mills already present. That's the high margin ore. That's going to put you very much in demand. But I'm always thinking through the lens of a producer, how desirable would this project be to be acquired if you already have guys in the area that are producing gold or copper? Or how desirable would this project be to build on a standalone basis versus the global competition for capital? Does this project really stand out as a high IRR project, an easy project to build? Because you can only build a certain amount of mines every year in the industry. So you've got to make sure your project really stands out, both from a strategic standpoint, it fits in a camp, or from a return and size perspective, that it has to be owned by a major. That's going to drive, liquidity events or takeouts in the business. And you will see a lot of M&A going forward due to the profitability, the cash flow of these producers, and their need to replace what they produced in the past.
Mm-hmm. Are there particular considerations that you have towards these secondary pieces of the puzzle here? As you mentioned, the basically the logistics of the operation. If there's a mill nearby or even on site, roads, power. Say a little bit more about the logistical side of actually producing mine.
It's often highly overlooked by investors. If you're going to a project that has a highway running through it, right, that's a huge advantage because putting down new roads will cost you hundreds of millions, not billions of dollars, right? If the project has power and low-cost power available, and you don't have to use diesel or fuel to burn to build your mine, hugely important. Do you have water? Do you have water access? Wildly important. Mm-hmm. Best case scenarios, do you have mills close by that are either abandoned or half-fed or lacking mill feed? Even better, you don't have to build a mill anymore. Do you have qualified labor close by that can work in your mines? That dramatically lowers your drilling costs. It lowers your engineering costs, your construction costs. Are you in an area where people want to work? Is it safe to go there? Is it helicopter supported? Is it, you have a camp in place? So these are all really important factors that when you're just looking at a company that has a resource, you've got to kind of cost that into your analysis. And like I said, that can cost billions of dollars to put in place if you don't have it already in place. So I put a high premium on infrastructure. If I'm investing in a area that doesn't have infrastructure, I put a high premium on really tier one, world-class quality discovery potential that could make it like Snowline Gold in the Yukon, like middle of nowhere, but you find 10, 15 million ounces, people will find the infrastructure. The infrastructure will come to you. So you really have to think through that lens. And that's why a lot of projects are never going to get built on, because they don't have the size, scale, grade to have their own standalone, or they don't have the infrastructure to make that economic. So you've got to think about that in advance. And that's why I don't do many site visits, Tom, because I'm not a geologist. I don't find it really valuable for me to go to site. But the ones I do go to, happily the ones that are easy to get to, both in terms of my schedule, but also it talks to if you can get in and out of a mine site in an hour, a day and a half, yep. Right? That tells you infrastructure is amazing. If you're taking a helicopter and then flying in the middle of nowhere and then taking a safari in the desert with a Jeep and you got to spend 4 days camping on the desert to get there, it probably tells you there's no infrastructure. Boy, you got to find some really good reserves to make that make sense. So infrastructure is really important and it's something people don't look at enough, and I think investors should focus on it.
Mm-hmm. I want to go back and touch on this idea of jurisdictions again, Michael. Where would you rate the jurisdictions around the world at this point, and where are you comfortable taking a risk on it?
So I will go anywhere in the world. The one no-fly zone for me is if I get to a point of expropriation. So it's kind of like I talked about with the size of the resource, is you're often trading off geology versus jurisdictional risk. So, Canada and the US probably do have the best rule of law. So if you own a deposit in Canada and the US, it's highly unlikely that you'll lose that deposit, and it's unlikely you'll see major changes to tax. You'll see incremental tax like we all do. Taxes go up everywhere. But you're unlikely to see major tax increases or royalty increases or changes that really drastically affect the quality of the project. But the trade-off there, as we talked about, is massively long permitting times. So you have rule of law, you have pretty stable fiscal terms, but you have impossibly long permitting times in these countries. So that's the trade-off there. You go to West Africa where you have incredibly short permitting times. So from discovery to cash flow, you can get going really, really quick. But you have less stable fiscal regimes. You've seen Burkina Faso, Mali, other countries increase their take of the government revenues from those projects. So you have less stability on the financial side, but really good pipeline to get to cash flow really soon. And then you have Latin America, which is always a mixed bag. It's swinging from left to right and pro mining to negative mining. So you're just constantly balancing these risks versus valuation. But I've always said you cannot say Canada good, Africa bad, Latin America bad, USA good. It's a jurisdiction by jurisdiction place as well within these countries. Canada, US have some states and provinces where it's impossible to mine, others where it's really friendly to mine. So to me, it's all about what's the valuation I'm paying, what's the risk on the timeline of value creation that I have a major jurisdictional change in political winds, let's say, and what is the likelihood of that investment going all the way to production or cash flow, and what am I paying for it? So it's very hard to answer that question with one brush, but it is jurisdiction, infrastructure are two areas that investors need to spend more time on, and you price it appropriately, in terms of what you're paying for an asset based on the risk you're taking in those two factors.
When we think about the costs associated with developing a new project, whether that be greenfield or brownfield, how do those projects, or how do you consider those projects needing to be releasing a PEA or a 43-101, basically a resource estimate or a mining cost estimate? Do they need to be going out and spending the money to do those studies, or if they're communicating drill results to the market and the market actually, let's say, for example, the majors have people that are looking at M&A targets, are they able to get away without having to spend the money on those big studies to be able to still attract that capital? Or is there a preference within the industry, do you think?
So two things. I would say, yes, you need to get a resource out at some point in time. I mean, best need to understand that resources are a snapshot in time, especially in a rapidly growing resource. You put the resource out, if you're still drilling it the next day, put the resource out, it's already stale because hopefully your resource continues to grow. You asked a question about majors. I'd say yes. After a certain point, you need a resource because the resources give the market an idea of the potential value. Yes, like guys like myself and majors can do their own work and extrapolate and guess or model what a resource would be. But I think it's very important for the market to have, a placeholder or an idea of what the deposit could be, because most people cannot model, and most people shouldn't be able to model because it's a very technical skill, what the resource size can be of a project. On the majors, that being said, so you need the PEA, you need the resource, you need that technical data. That being said, any major is going to buy a product. I've had a lot of interaction with the majors the last several years talking about projects and how they look at acquiring projects. They do all their own work. So they're going to take that PEA and that resource, they're going to drop it in the garbage, and they're going to put their mind building team on it who are going to do all their own work, and they're going to come up with their own resource, their own cost parameters, their own economic studies. But as a starting point for a discussion, it's very important to have these resources and MREs if you want into a corporate transaction with a major. And it also tells the major mining company how serious you are. So there's different degrees of seriousness that are done in PEAs. Some PEAs are like toilet paper quality, and other PEAs are corporate level quality. And the difference is that you might have very flimsy assumptions in your PEA in order to try to pump up the net asset value as much as you can. Or you can take the approach of a junior saying, look, I'm going to put a lower IRR, a lower NPV, but I'm going to model like a Barrick would, like a Nika would, like an Alamos would. So when they come into my data room, look at my project, they know that we're serious. We're putting the right parameters in there. So they're also going to be assessing the seriousness and the depth of your technical team. I think that's important too. So yeah, they're very important markers. And you also want to see projects that are constantly growing in value, that are constantly increasing value, optimizing, finding new higher grade pockets, growing the size of their resource, looking for creative ways to lower their CapEx, shared infrastructure. So it also gives the market a bit of a report card on how the project's progressing on a valuation perspective as well. So I think they're quite important. But when you do them, timing of which really depends on the project, how fast it's growing and progressing, and where the market is in terms of understanding it.
Mm-hmm. Michael, you mentioned this idea of wearing two hats, both of a generalist investor and also a junior mining investor. So for new investors to the junior mining side of things, where do you think that they should start? How do we, let's say, structure a portfolio to both de-risk and have exposure to the leverage within this industry?
Yes, if you're just starting out, like the charts I said, I think the producers in general are still really, really cheap. In general, they're a little less risky. So I just started skiing a couple of years ago. I'm a lifelong hockey player, but I found a new passion in skiing. So I often use my skiing. When I first started skiing, I was on the bunny hill and very slowly going down the hill, learning my bearings, right? And so for many new investors, the gold sector investing at all, they're new to it. So you want to go on the easiest run possible. So I would encourage investors to look at GDXJ or GDX, which is the ETFs that own a basket of producers. And if you believe in the gold thesis, and you believe that gold stocks have a good chance to outperform the market in the next several years, you buy a basket of those stocks, you'll do well, you'll have a nice return, and you won't have a major, down 60 or 70% stock in your portfolio. As you get more and more comfortable and you get more and more experience and you spend more and more time on the sector, you can kind of go to the blue runs, the black diamonds, double black diamonds. Junior resource microcap investing, it's a double black diamond sport. You have to be a really good skier to know what you're doing. You have to have a game plan to get down the hill and do a good job skiing it down. So for me, how I approach the junior resource sector is that 25 to 30 stocks in my portfolio, 1% of my net worth each. Again, looking for those multi-bagger returns. So if you want to invest in junior resource sector, my first piece of advice would be don't just buy one name. Don't hear me do an interview next week and say I like company XYZ and you put all your money in that one stock. Because like I said earlier, the law of averages says that one stock will probably not work. So you want to have a diversified portfolio of 25 to 30 names. Be systematic in your approach. Look to make those multi-bag returns. So understand you want to make 10, 20, 30 times your money and be very systematic about it. But it's very hard for most investors to be patient. It's very hard for them to be systematic and very hard for them to be rigorous in that, constantly applying that approach. So I would say for the most investors, ETFs, index funds are a good way to get involved. Then if you want to move down to producers, you could buy a basket of producing stocks that generate cash flow. And as you get more and more comfortable and more knowledgeable, migrating down the market cap spectrum will increase your potential returns, but also your risk. So you've got to be aware of what you're doing and the factor approach to doing it. And there's no free lunch. Higher returns means higher risk, lower returns, lower risk. But if you get the sector right, a rising tide lifts all boats. So all these stocks should do really, really well. And you can kind of pick your lane based on how much time you want to spend and how comfortable you are doing the work.
Right. But let's say as a percentage of a portfolio, Michael, do you have any hard limits for saying, you mentioned earlier having a 1% position as a part of your entire portfolio of a particular project that you're really looking at? Should the junior mining sector only, let's say, encompass a total of 20% of your entire net worth or portfolio, or any other rules like that?
For sure. I was talking more about your allocation to junior mining, for sure. That's a great question. So I would say the stats tell you that currently of all investment accounts globally, 0.5% of total investor money is allocated to the gold sector. Now you saw my slide.
Sorry, is that physical gold and the mining sector?
Just allocate to gold, precious metal equities, and physical. Physical gold is much bigger than the actual equities markets, but let's say the total invested capital in the space. So if you have $100 invested and the average investor has 50 cents invested in gold stocks. So I would argue that should be much, much higher. And you saw the charts that I showed, the rotation and valuation. So should you have 100% of your money in gold stocks? Absolutely not, right? If you're the average investor. I'm a bit crazy. I have a very large portion of my money in gold stocks, but I'm a double black diamond skier. I know what I'm doing. I have a thesis and I understand the risks involved. So I would say that, at a bare minimum, I would say 5 to 10% of your portfolio should be in gold or gold-related equities. And the reason is again, the devaluation of the dollar, the massive rotation we're seeing, the inability of governments to pay back their debt and money that's worth anything. So that gold, as a bare minimum, will act as a wealth preservation tool for you. I saw a great slide the other day, Tom, that a physical bar of gold in 1960 bought you a nice house in the US in 1960, and a physical bar of gold in 2025 bought you a really nice house in the US. If you took the cash that you had in 1960 and put it under the mattress, the 60 grand, whatever it was, that wouldn't buy you a garage these days and a house in the US, right? So gold will preserve your purchasing power of your money. It is money that cannot be printed. And so gold will preserve the value of your portfolio. And then if you want to go beyond that, equities have leverage the gold price, can outperform gold or underperform gold, depending on how they do. But it'll act as a nice wealth preserver. And also you saw in the markets, as tariffs got really difficult, the economy went to collapse mode or panic mode, gold stocks went up. So having something in your portfolio that goes up and everything else is going down is very valuable. So I'd say minimum 5-10%, more if you're more convicted on the thesis. But you never want to go all in on one trade. I mean, things happen, things can change. But in general, investors are dramatically underweight, under-owning gold and gold equities. And that is the kind of multi-year, multi-decade opportunity I see ahead of us.
Mm-hmm. Excellent, Michael. Well, I think that's a good place to kind of wrap up for today. Is there anything that you'd like to leave our listeners to think about or to consider before we do?
Now we've got a really amazing, comprehensive discussion. I really appreciate, Tom, what you do in terms of educating people and insights. There's a tremendous amount of information out there. So if you do want to take a time to educate yourself on why gold's working and how you invest in the sector, there's a great amount of resources out there. Yours being on top of the list in terms of how people understand what's going on. And so I'm really, really happy to be on the show and to appreciate the work you're doing for your viewers.
Well, I definitely appreciate that, Michael. I appreciate the vote of confidence. We do work very hard to try to just bring education to the space, because there is a lot to understand, and hopefully having these discussions, being able to, as you said, triangulate based on different pieces of information, I think is extremely valuable. Of course, if anybody wants to know more or read more from Michael, he's available on LinkedIn, as well as bastion-am.com. Michael, thanks so much for your time today. Really appreciate it.
Great to see you, Tom. Thanks for your time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.